Hey everyone, SoFi Technologies and Upstart Holdings are two interesting financial technology or financial services companies to compare. In this video, I'll look at these two and their revenue, their profitability, their prospects over the next 5 years, compare them against their valuation, and answer which one I think is the better stock to buy today. So let's get started with revenue.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right. Interestingly, you'll notice that Upstart and SoFi were on the same trajectory up until early 2022, where you saw both of them. You saw the divergence here, where SoFi continued rising in revenue and Upstart experienced a big slowdown and has failed to recover from that significant slowdown. The big difference, the cause of Upstart's slowdown is the concern from lenders on its platform. They were worried that as the Federal Reserve raised interest rates, that the economy would slow down. Job growth would decrease. In fact, there would be layoffs. People losing their jobs would have a hard time paying their loans. And they did not want to make loans on the Upstart platform using the AI model it implements. So they were fearful. They were concerned with the risks. And so they pulled back, and that caused a big slowdown for Upstart because Upstart aims to be a platform that brings together borrowers and lenders using its AI model for lenders to make loans on the platform. Upstart didn't want to use its own capital to make loans, but because the lenders on the platform took such a big step back, Upstart was forced to use its own capital to make loans so that it could push the business forward, and it has yet to recover from that slowdown. Now, longer term, as Upstart's AI lending model gains more data, gains more experience, has more data in terms of customers going through job losses and the economy going through a slowdown, and then it proves how effective the model is, it's likely that lenders would step back in the platform. Now, SoFi Technologies, interestingly, recently received its bank charter in the last few years. That's helped SoFi attract billions of dollars in customer deposits, which it then uses to make loans. So SoFi does use its own capital for the most part to make loans. Now, sometimes after it originates the loan, it sells it to investors if the economics are favorable. But it has the option to keep those loans on its balance sheet and service them and take and collect the payments. So SoFi does use its own capital, whereas Upstart tries to be a platform that brings together buyers and sellers using its proprietary artificial intelligence technology. So those factors have caused a divergence between these two in recent years. Now, looking at profitability, they're very, very close, as you'll see. Upstart negative 175 million in the most recent trailing 12-month period, and SoFi with negative 178 million in the most recent trailing 12-month period. The big difference is that SoFi has been profitable on the bottom line for the last 2 quarters and is forecasting strong growth in profitability for the foreseeable future. Whereas Upstart has failed to return to profitability. You can see back in 2022, the business model was profitable. They were generating strong profitability on the bottom line when revenues were much higher and the business was more geared towards the marketplace business model, bringing borrowers and lenders together, and Upstart was just taking a fee from all of those transactions. That was a lucrative business model. If it can get back to that point, it's very likely the business will return to those levels of profitability. The big question mark is, will it ever get back to that level? Will it ever get back to that point? And I would say yes, it would, because once it collects enough data, then lenders would become more comfortable lending on the platform. Even if the data is not good data, as long as there's more data, then lenders can use the data to make decisions. right? Even if, let's say, the data is bad, then lenders can still use that decision. They can say, okay, the data suggests that based on your model, we're going to charge 9% interest to people borrowing on your platform. If the data is better, then they can say, okay, we'll charge 6% interest. Whatever the data suggests, they can use the data to charge an interest rate that associates it with the risk that they're taking. But right now, since lenders don't know the level of risk they're taking, they don't feel comfortable with the decision. They don't feel like they can make an informed decision using the Upstart AI model. It's still too early. There hasn't been enough data collected, not enough years, not enough difference in the conditions of the macro economy, right? In the last few years that Upstart has been operating, the macro economy has been really, really strong. Unemployment has been below 4% or around 4%. Job losses have been minimal. And so they haven't experienced that big downturn when people lose their jobs. How many people are going to default on their loans using that AI model versus the traditional lending model? So that's the data that investors and lenders are looking for before they feel more comfortable with making loans on the Upstart platform. Now, since these companies have been losing money on the bottom line, they have been diluting shareholders, but Upstart recently actually was buying back its stock. It was using some of its money to buy back shares and reducing the share count, whereas SoFi is still diluting shareholders significantly. Their number of shares outstanding has exploded from around the same level with Upstart, you'll see here in mid-2021, and it has absolutely exploded. It now has 1 billion shares outstanding versus just 87 million for Upstart. So Upstart has not been diluting shareholders. The reason this is important is once these companies, or SoFi is already profitable on the bottom line, with more shares outstanding, it's going to decrease the earnings per share because the net income is split among more shares. Whereas for Upstart, it's still the same number of shares outstanding or a little bit less. So if or when they return to profitability, those profits will be split among fewer shares, thereby increasing earnings per share. Finally, I wanted to compare these two on valuation, measuring using the forward price to sales ratio. And they're similarly valued, but SoFi is less so, trading at a forward price to sales of 2.6, compared with Upstart trading at a forward price to sales of 2.85. So given Upstart's yet unproven AI lending model, that stock is a little bit higher risk. Also, SoFi has made more progress on profitability. So based on just those two primary factors, because those two factors are so huge, and SoFi is expecting such a surge in profitability over the next few years, whereas Upstart's profitability prospects are a little more uncertain. If I had to pick between these two today, I would pick SoFi stock as the better stock to buy right now. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.